Hey guys, welcome back, and today we're gonna continue with the fair value gap, but now we're gonna talk about advanced stuff which is important to know, and we're gonna talk about inverse fair value gap. We know about fair value gaps, now it's gonna be inverse. This information, it's important, and if you're trying to combine liquidity gaps and inversal fair value gaps, you can find an amazing trades with amazing risk and rewards, but you have to understand this concept. So let me show you some examples. Yeah, okay, this is the recent trade. We're gonna take it out, removing everything, and we're going to draw some. I'm gonna show you. We have, once again, something like this. Yeah, we have the range market, we have our support zone here, we have our resistance zone here, and now what do we need is find the right way to enter the trade. Inversal fair value gaps is basically, I'm using it on 5-minute time frame. This is what I'm recommending you, but basic idea is how the market moves and where to find those inversal fair value gaps while the liquidity is taken out. Yeah, so we have what? Here we have our liquidity graph, and we know that, and what we are looking for is the impulsion. We're looking for the impulsion from the institutions when they starting to get the money. So now we're gonna talk about this straight down. Yeah, now we have something like that. Yeah, we have 1, we have 2, and for example 3 big candles down. Yeah, example, there was a wicks, something like that here, and we know the concept of the fair value gap. Yeah, sometimes when the liquidity is taken out, you're gonna see a huge movement. What I mean by that, the next candle can look something like, okay, something like that. Yeah, I'm gonna change the color. It's gonna be green because now we are going up. So this green candle represents this movement. And now we had a fair value gap, but that fair value gap was without respect, straight to the top. This is called inverse fair value gap when you enter the position after the huge candle. This is what I am doing. And the candle closed strong above the fair value gap, and you're entering the trade here. So now there is two options. The safer option is, as we talked in the previous video, to put your stop loss below the liquidity graph, if that's the correct liquidity graph, and you're targeting something, also suggesting at least 1 to 2 risk reward, which would be more powerful. Okay, yeah, 1 to 2 risk reward, and I just want to show you the examples. 1 to 2, yeah, right now we have 1 to 2. But what I'm doing in the smaller time frame, when inversal fair value happens after the liquidity graph, I'm entering the trade and I'm putting my stop loss just below the fair value gap, the inverse fair value gap. But it's a little bit riskier. But now look at this. We have a 1 to 4 risk reward, so basically double. The risk is higher, but of course the reward is also higher. So this is the understandable. Yeah, this is understandable that liquidity grab was taken from the bottom, and then this price starting shooting and going up. Same goes if the price goes up, taking out the liquidity, and after that it's going down. Yeah, this case scenario. So we're gonna have also something similar. It's gonna be 1 candle, 2nd candle, yeah, wait, 2nd candle, and the 3rd candle, and after that it's gonna be huge, or it's gonna be several huge candles here. Yeah, the red candle. Okay, let me talk. And now we had what? We had our liquidity gap right here, not the liquidity gap, the fair value gap, and it was without respect going down. So what you're doing, you're putting your trade, you're putting your stop loss, and then you're targeting something. It's simple. When I'm drawing, now let's go to the charts. Yeah, so the charts on the 4-hour time frame. I don't know if I can find something, maybe, but yeah, it's better to go on the 15-minute time frame. It's gonna be easier, it's gonna be faster. And look at this. Yeah, 15-minute time frame today. We had a zone here, yeah, something like that. The price was bouncing from it, so we had a demand. After that, what happened? We had some dump, huge dump, and the last candle was enormous. Yeah, what we are doing, we're drawing our fair value gap, and we're waiting. If the price gonna respect it, for example, something like going there, and after that creating a new lower low, or like in this case scenario, look at this candle, this one, it goes all the way up, all the fucking way up, and we can enter the trade. Yeah, when the candle is closed above our fair value gap, now it's inversal, so we're putting our stop loss. Look, if I put below, I would lose, but yeah, in this case scenario, I think I would put here because of the wick, which was going down and now going up. So for safer, yeah, you're putting the stop loss below your liquidity grab. See, not one candle but several still, and you're targeting, for example, the highs. Yeah, you're targeting the highs, which is gonna be here, and you have basically 1 to 2.7 risk reward. Amazing trade, amazing. Now let's try to look for the example real fast. Something, oh yeah, look at this, it was bouncing a little bit, liquidity was taken, we have our fair value gap, and after that we was looking if it's respecting or not, but the green candle goes all the way out. Yeah, we can enter the trade after the candle closes, putting our stop loss below the liquidity grab and targeting something. In this case, for example, highs of here, the consolidation, or the highs of here, which is also gonna be a nice and fucking amazing trade with almost 1 to 3 risk reward. Of course, it's gonna take time, but that's the whole idea. So yeah, guys, thank you so much for watching. If you didn't get it, watch again. This concept is fucking amazing, that's for sure. I'm still using it, and I'm gonna teach you more deeper in the academy. So on September 1st, join. It's gonna be worth it, I promise you. Thank you guys for watching, and see you in the next episode.